and March and April. So sales for November, we're given the actual numbers were 260,000. December were 340,000. January's forecast is for 400,000. February's is 440,000. March's was 410,000. And April's is 400,000. Now it says of the firm's sales, 60% are for cash and the remaining 40% are on credit. Of the credit sales, 20% are paid in the month after the sale and 80% are paid the second month after the sale. So that helps us figure out exactly what our cash sales were. They should be at 60% of total sales. So that's as easy as just taking total sales and multiplying it by 0.6 to calculate the cash that we received. And we can copy that formula across. Alright, so cash sales for each month are there. Let's go ahead and format this spreadsheet so that it looks somewhat pretty. Doesn't have to be perfect, but at least we know we're looking at dollars here. So cash sales, then it said credit sales, remaining 40% are on credit. Credit sales, 20% of that number is paid in the month after the sale and 80% are paid in the second month after the sale. So our credit sales are going to be 40%, or there's going to be our total sales minus our cash sales, right? And we just multiply that again. We copy and paste that across the board. Now to calculate collections month after credit sales, that's 20% of the previous month's sales. So we will take the previous month's credit sales, multiply that by 0.2, and that gives us the amount of cash we're receiving in that month for the portion of sales that happened the month before. Alright, so we're going to do the same thing and copy that formula over. Okay, and then collections 2 months after will be 80% of the previous of the 2 credit sales. So that's times 0.8, and we can multiply that or copy that formula across. Alright, so our total cash receipts we can calculate. Starting in January, that's really what we're most concerned with here. January through March would be our cash sales of 240,000 plus collections 1 month after plus the collections 2 months after. This is our total cash receipts for the month of January. And again, I'm just going to go ahead and paste that formula across. So that tells me the exact amount of cash that I should be collecting based on our sales forecasts. That's total cash receipts for each month, January through April. That's our cash receipts numbers. Now, we can do a cash payment schedule. All right, according to the problem, materials cost 20% of sales and are purchased and received each month in an amount sufficient to cover the following month's expected sales. Materials are paid for in the month after they are received. In other words, materials are paid in the month it looks like that they are sold. And they're 20% of sales. So materials the materials again are the equivalent to 20% of current sales, because we're buying them in the previous month but then paying for them in the current month. So we can do this just for January, February, and March. Those are the 3 months that we're most concerned with. So let's see, materials is 20% of current sales, so we take current sales, multiply that by 0.2, and that's our cash disbursement for materials. And we're going to go ahead and paste that formula. Okay, those are cash disbursements. Labor, the problem says labor expense is 50% of sales and is paid for in the month of sales. So that's really calculated. Labor 50% of current sales. Sales times 0.5. All right, so we're getting a bigger picture here of our cash disbursements. Selling and administrative expense is 15% of sales and is also paid in the month of sales. So that's 15% of sales. All right, then we have some other information. Overhead expense is $31,000 in cash per month. Okay, overhead. They tell us it's $31,000 each month. And then depreciation expense is $10,600 per month. Is depreciation a cash expense? Cash disbursement? No, it is not, so we're not going to include that. Taxes of $8,600 will be paid in January, so we have to consider that. $8,600 in taxes paid in January, and dividends of $5,000 will be paid in March. Cash at the beginning of January is $92,000 and the minimum desired cash balance is $87,000. All right. So let's take a look at our total cash outflows here for each, or cash payments. So cash pay. That's going to be the sum of those numbers, right? And then we can copy that formula and paste it across. So we have a beginning cash balance we have net cash flow. Let's go ahead and calculate that first. Net cash flow is going to be the cash inflows or cash receipts minus cash payments or cash disbursements. And we will calculate or copy that formula as well. Okay, you can kind of see what's happening here with our net cash flow. We're using cash up in January and February, and then we're putting cash back into the bank account in March. So our beginning cash balance we were told is $92,000. Okay, and we're also told, according to the problem, that we want to have a minimum desired cash balance of $87,000. So we start with $92,000. Okay, that means we're going to have to borrow some money to get our ending cash balance back up to 87, aren't we? Because we're going to use 29,200. So balance before loan, then loan, then balance after loan should always be 87,000. So balance before loan is going to be the 92,000 we had minus the 29,200 we used. So that means in order to get 87,000, all right, we're going to have to borrow some money, aren't we? It's going to be the difference between the 87,000 and the 62,800 we have. We're going to have to borrow 24,200. Okay, and then what happens here is our beginning cash balance becomes 87,000, and then we can actually edit and copy these formulas over. And you can see that we're going to have to borrow another 200, but then 87,000 is our beginning cash balance here. We add to our bank account and we pay off our loan in full in March. And we are left with 87,300 in the bank at the end of March. So we have just prepared a complete cash budget, which tells us exactly how much we're going to have to borrow and when in order to make sure we maintain our minimum.